Welcome to Yahoo Finance Live. I'm Shauna Smith along with Dave Briggs. Let's get you up to speed on this afternoon's market action. Taking a look at the major averages, we're looking at gains across the board. The Dow up 160 points, so well off the highs of the day. Taking a look at that intraday chart, we were up just over 400 points at the highs of the session, but still well above 33,000. Nasdaq Composite here up just about 1.6%. We're seeing a lot of those tech names lead to the upside today. S&P also holding on to gains up nearly 1%. Taking a look at the Philly Semiconductor Index, that's up 4% today. A bullish note out from Barclays on a number of the chip stocks is sending that index up even higher. Year to date, we are looking at significant gains there, up just about nearly 15%. Taking a look at the sector action as we talk about some of the outperformance in the semis, technology is the outperformer today with the XLK up just about 2%. Communication services not too far behind. Lagging behind though in the red, we have materials and utilities. Utilities, the worst performer of the day inside the Nasdaq, talking about some of those larger tech giants leading to the upside. We're looking at Apple up just over 2%. Tesla up nearly 7%. Nvidia getting a huge boost here. Apple and Tesla also moving on news of the optimism surrounding China's reopening. Taking a look inside some of these semi stocks, we'll be talking a little bit more about that later on in the show, but certainly a lot of green on your screen. As you can see, Nvidia by far the leader of the group, up about 6.5%. AMAT not too far behind. Micron up about 4%, Dave.
Quiet week for the Fed, which is nice. Yeah. We won't have to dissect each comment coming out. A lot of earnings, though. Big time week in earnings. What are you looking forward to?
You know, it's a huge week for earnings. About 40% of the Dow is going to be reporting. I was just mentioning some of those tech stocks. Microsoft will be one of those names. Tesla is going to be huge, but the list keeps going. There's a lot of ones.
Credit cards, Amex, MasterCard, Visa. Get a look at the consumer.
No shortage of news.
Nope. Thank you, Shauna. Let's get you up to speed. Now on major headlines this afternoon. Activist investors setting their sights on Salesforce amid slowing growth and layoffs that the software giant announced earlier this month. The Wall Street Journal reporting Elliott Management Corporation has made a multi-billion-dollar investment. Jeff Ubben's Inclusive Capital has also taken a position on the software giant, according to other reports.
Spotify is the latest tech giant to announce layoffs, cutting about 6% of its workforce. The streaming company saying that it amounts to about 600 jobs. Chief Executive Daniel Elk saying that he was too ambitious about the company's growth. Now, Spotify's spending grew at twice the speed of its revenue last year as the company leaned heavily into its podcast business.
And Elon Musk testifying in federal court this afternoon that Saudi Arabia's public investment fund wanted to take Tesla private. Musk is being tried in San Francisco in a class action lawsuit from investors saying they lost money when he tweeted about taking the company private in the summer of 2018. It was that money from the Saudis, who had amassed a 5% stake in the EV maker at the time, that Musk claims prompted him to make the claim that he had, quote, funding secured. Those words that continue to resonate years later. Our Alexis Keenan keeping an eye on that trial. We'll have more from her later on in the show.
Lots to unpack today. Well, investors taking a glass half full approach this afternoon with some indications the Fed could slow rate hikes to about 25 basis points. The blackout period has started, however, so it's all about results season now. The likes of Microsoft, Tesla, Intel among the host of reports on the docket this week. Here to break it all down, we want to bring in Christina Hooper, Invesco Chief Global Market Strategist. Christina, it's great to see you here. So we're off to a pretty strong start this year. You have the S&P up just about 4%, the Nasdaq, the leader, up about 8% since January 1st. What do you make of the gains and what we've seen from earnings results so far this season?
So I think that a lot of the gains we've seen thus far have been driven by optimism around inflation moderating and the Fed getting closer to hitting the pause button. I don't think they've been driven by earnings, even though thus far, although it's early into the season, we've seen relatively good results. I think the expectation is that there is another shoe to drop in earnings. Some of it we'll see in the reports for the fourth quarter. Some of it remains to come in following quarters, but I do believe that that is actually going to be more of a headwind in the coming months as opposed to a tailwind.
Are there particular sectors you think will be punished when we hear these earnings start to roll?
Well, I think any company that really negatively surprises is likely to be punished. There are opportunities to manage expectations, and typically Wall Street rewards that unless it's really a very bad earnings report. So my expectation that it is not going to be sector specific. It's really going to be company specific. I mean, certainly we've seen a lot of negative headlines around the tech sector, especially around layoffs, but that can be a double-edged sword, right? Because while it's an admission of problems that most investors have probably already recognized, it also can be viewed as a positive because it's an opportunity to cut down costs and reposition for the future.
We get huge reports from IBM, from Intel, from Tesla, from Microsoft, from Boeing, and at the end of the week we get a couple of big credit card names, Amex, MasterCard, and Visa. What do you expect to learn?
So what's most important to me is really what I glean about the overall economy. And so certainly any tech company can tell us what's happening in terms of demand for example, cloud computing. We heard from one company that many companies, their clients, are looking to cut down on costs in terms of storage and cloud use. So that's very helpful in terms of gauging the environment. The credit card companies are going to be particularly important because they're going to tell us about the health of the consumer, which of course is critical to the U.S. economy. We've already heard from some financial services firms that have told us about an increase in credit losses, for example. One firm that reported earlier today talked about a K-shaped recovery. And that's all very helpful in terms of filling in a picture about the U.S. economy right now and what we can expect going forward.
So, Christina, lots of focus on earnings, but there's also clearly a focus on Fed policy in terms of what we're going to see the Fed do next. Mohamed El-Erian, he was on this morning saying that he thinks that maybe 50 basis points, he's in that camp, rather than 25 in terms of what the Fed should do. He said that in an interview this morning. What do you think is appropriate coming up here for the Fed?
I think 25 basis points is appropriate. We're seeing inflation moderate. Certainly where it is today is not where the Fed wants it to be. It's a ways away from the inflation target. But the Fed has to essentially execute a delicate balancing act. It doesn't want to do so much that it essentially kills the U.S. economy. Think of it as someone getting in the shower in the morning, you get hit with cold water, you turn the spigot all the way in the other direction, and then you scald yourself. We want to prevent that from happening. We don't want the Fed to scald the U.S. economy. So I think 25 basis points makes sense.
Surprisingly how refreshing a cold shower can be, Christina. As a cold shower fan, I just want to put that out there. I've been trying to sell Sean on this for quite some time. Cold showers can be therapeutic.
I'm not sold, and I never will be.
I'm with you, Christina.
I had a hot water heater broken for 2 weeks. I had no choice. You mentioned some headwinds as we see earnings start to pour in. China begins to reopen. How big a tailwind is that for some economic data?
Well, it's certainly a very big positive for the Chinese economy, and that can extend out from there. So Asia will benefit. We're likely to see better economic growth across Asia as a result of the China reopening, assuming all goes well, which I think it will after a hiccup in the first quarter. And of course, that can even help the global economy. So should be a positive, although the U.S. is on a very different trajectory in terms of really trying to limit the level of slowdown and avoid a recession right now. China's in a very different place. It has ripped off a Band-Aid and is ready to really, I think, take off. It'll take a little time, but I think we're going to see strong growth this year.
So, Christina, given the reopening in China, which we were just talking about, Fed policy, also earnings, how are you positioned right now?
So I have warned our investors, our clients, that we should anticipate a tug of war. We're going to be buffeted by different economic data points as well as Fed speak. But I do believe as the year progresses and as it becomes clear that the Fed is going to hit the pause button, and it does in fact hit the pause button, that really creates a place for the economy to begin to recover. It will take some time, but stocks and markets in general tend to discount that in advance. So I do think we're going to see more of a risk-on environment as the year progresses. But right now, I anticipate a tug of war between risk-on and risk-off.
All right, Christina Hooper, it's kind of like the shower. Invesco Chief Global Market Strategist, thanks so much. Shauna, you never try the quick, like, I go
When
quick
I've been
cold
forced.
shower. My wife goes long hot shower.
Do you always go cold shower? You haven't exactly
have
had the choice the last couple of weeks
No.
with your hot water heater broken.
I
So we got to
don't.
do full disclosure with the cold showers.
True, but I have learned a lot about how rejuvenating it can be.
Yeah,
better than
I
coffee,
enjoy the
man.
warm showers. I'm going to stick to them for right
All
now.
right, sounds good. Just getting started here on Yahoo Finance Live. We're like a cold shower sometimes. Coming up, big banks are reportedly teaming up to take on digital payment platforms like Apple Pay and PayPal. Find out how and who next. And how Spain mortgage rates have dipped. Homebuilder confidence is up, but inventory still sits below that key 1 million unit level. We talk all things housing ahead. And Avatar, The Way of Water hits a milestone at IMAX Theaters. CEO Richard Gelfond will tell us more about it and its impact and what's coming down the pipe. Don't go away. Shares of Salesforce on the move today, as you can see, up more than 3%. Several activist investors are said to have taken interest in the software as a service giant. Elliott Management has taken a multi-billion-dollar stake in the company, a source confirmed to Yahoo Finance today. This comes on top of activist position from Starboard dating back to October, and CNBC reporting today that Inclusive Capital is also taking activist stake in Salesforce. Here to break down what all this means for Salesforce is Patrick Gadsden, Vincent Elkins' partner and co-chair of shareholder activism practice. Good to see you, sir. Your firm has defended clients against both Elliott and Starboard in the past. So ballpark it for us. What does this mean for Salesforce?
Sure, and thanks for having me. Appreciate it. The first thing we should understand is that Elliott has a history, right, of not going public with anything or not even allowing any leaks until things have broken down privately when they're engaging with management, right? So we have to assume that they've been privately engaging with management, maybe even a few members of the board, particularly members of the Nomination and Governance Committee since maybe early fourth quarter of last year, right? So this is usually their blueprint. Things either go their way and they remain private, and the first time you hear about them publicly may be in connection with an actual settlement, or things break down and then they start, dribbling little dribs and drabs of information to the public about their presence. And coincidentally, we are not too far from Salesforce's opening of its nomination window, which is when shareholders have the opportunity to submit nominations for contesting slates at this year's annual meeting. So this is no accident. What they're basically saying is, look, we didn't want to have to go public, but you aren't doing what we said, or at least what we think you should do in the short term. So we're going to maybe leak a little thing here or there. And, nod, nod, wink, wink, your nomination window opens pretty soon. So the market's going to interpret our leaking of information now as potentially a run up to making real sort of bombastic nominations in the coming weeks.
Yeah.
So go ahead.
Oh, Patrick, sorry to cut you off there, but going off of that, just in terms of the exact changes that you think they are pushing for, given that aggressive style that you were just talking about and their history of being so aggressive, the number of changes that they typically push for and the conversations that you think that are going on inside Salesforce right now, what do you think that's like?
I think that in all likelihood, they are not pushing for anything different than what was in Starboard's deck. All right, when it released its deck on Salesforce last year. So they're concerned about margins. They're concerned about performance of the company and its valuation since Slack. Nothing new or innovative that no one's, not talking about. What they're really pushing for in all likelihood, though, is potentially board representation, right? So unlike a lot of activists, when Elliott shows up, everyone sits up straight, right? It's like, the U-2 spy plane when it flew over Cuba, and you got the actual pictures of missiles in Cuba. Everyone really paid attention. That's what happens when Elliott shows up. Everyone sits up straight and pays attention. And they know that, in all likelihood, Elliott's going to want some changes in terms of board composition. Now, how many changes, how many seats, whether it be someone from Elliott or someone they designate or they can mutually agree upon with the company, we don't know. But the real tension here is, does Starboard have the same agenda? And does Starboard want board representation? And if they do, is it choose your own adventure where you have to pick one or the other? Or could you potentially have a global settlement with both of them that gives you sort of ultimate activist repellent coming into this year's proxy season? That's probably more unlikely. In all likelihood, they'll probably have to pick one. And with reputations as strong and fierce as Starboard and Elliott, it's really tough to pick your own poison.
When you Google or even YouTube Paul Singer and Elliott, you hear words like vulture, bloodsucker, raider, but also admired and respected. How would you tell someone that isn't all that familiar with what they've done, how they've earned this reputation and why?
I would tell a potential client who had never heard of them, which is unlikely, that they are the Godzilla of the space, right? They make entire countries in South America tremble. Mm-hmm. So they are known to see things all the way through. And many activists are sort of price sensitive when it comes to running campaigns. Elliott is not. They are completely inelastic when it comes to their budget for any proxy contest, any proxy wars. They'll spend tens of millions with the expectation of maybe getting a win. And in that respect, they are far more dangerous than, say, your mid-cap activists who may not necessarily have the wherewithal financially to support a full campaign. Elliott will send out, iPads with loaded presentations on them to institutional shareholders. That's a different world of budget, right, for shareholder activism than most activists can actually afford to supply. So they are absolutely, if not the most aggressive and most feared shareholder activist in the world. They are up there in the top 2 or 3, and they aren't 3.
So, Patrick, if you're Salesforce right now, if you're Benioff, what do you do?
Well, you do your best to constructively engage with Elliott. You let them know, it's unfortunate that this leak happened. We hope to not see any more leaks like this again. Let's actually all get into a room, all get our lawyers on the phone and figure out a way to reach a settlement here. Nobody wants a long, entrenched, bloody Stalingrad war leading in this year's proxy season. What they're looking for is peace. So if it's one board seat, if it's two board seats, you have to really consider it. Now, obviously, you aren't going to negotiate and give up control, but it doesn't sound like, based on what Elliott's disclosures and what their statements were about the situation, it doesn't seem like they're angling for that. It seems like, in all likelihood, they're angling for representation. And the best case scenario for Salesforce would be a mutually agreed upon, fully independent person from Elliott, someone who's totally well respected, that each side can agree upon will be a voice of change in the boardroom, as opposed to Singer himself getting to the boardroom and banging on tables and bullying and persuading and cajoling people to bend to his will. So if you are actually the company or you're the board here, it's all about how do we avoid this going all the way to a tabulation of votes at annual meeting, and what can we actually give up that's reasonable to get that done.
Well, Patrick, this is awesome. Very insightful. We hope to have you back in the future. Patrick Gadsden, thanks so much for joining us. Vincent and Elkins, partner and co-chair of Shareholder Activism Practice. Thank you. Well, coming up, musical chair Spotify becoming the latest tech group to battle layoffs as the economic reality of a series of rate hikes sets in. How much pain can the sector endure? We'll discuss that next. Apple looking set to expand in its first major new category since the Apple Watch in 2015. And according to a report from Bloomberg, a both augmented and virtual reality headset could be even more ambitious than you had imagined. Yahoo Finance tech reporter Dan Halley is here to give us the latest on that device. And Dan, what do we know?
Yeah, this seems to be a new development in how we're expecting the new headset to come out. Really, this is going to be, as you said, one of the biggest products that's Apple's launched since the Apple Watch. And according to this report, there's going to be multiple levels to it that help differentiate it from offerings from the likes of Meta. Chief among them, there's not going to be any controllers involved. Instead, it's going to rely on cameras on the inside and outside of the headset that can see what you're looking at. And then when it recognizes that, sees what your fingers are doing and allows you to access things like buttons in apps to really interact with things. That's rather than using a controller where you would move around a mouse pad-esque kind of device and then use buttons to physically click on an item. So this is a big change from what we're seeing in other areas. Microsoft's HoloLens had a similar idea where you would look at something and then move your hand to kind of try to grab it, though it was pretty spotty at times, at least when I used it in some testing. So, it's hard to tell how accurate this would be, but if Apple's going to be going to market with this generally for $3,000, then you got to imagine that it's going to be pretty up to snuff when it comes to the capability there. And then they're also reportedly working on a less expensive version around $1,500. That's around where Meta's top of the line headset starts right now. And really this comes down to, whether Apple is going to go full force into this or not. They've done years of research on this topic. And so, there are times where they've thought about coming out with something and then didn't. But at this point, it seems as though this is definitely on schedule for this year at some point to be released to the public.
Dan, Apple also facing some competition over in the payment space as big banks, Bank of America, JP Morgan, Wells Fargo team up to create their own virtual wallet. What can you tell us?
Yeah, this is going to be something that you would use online, and it really is a way to compete with the likes of Apple Pay and PayPal. Apple Pay has kind of exploded in recent years. It's a slow burn, though. It started off initially very slow with, few people really jumping into it. And now, a majority of iPhone users seem to use Apple Pay to some degree. I frankly use it every time I go to the store, anytime I check out from, Grubhub, anytime I go and get on the train, I use it. So it's something that's become a part of my everyday life. And I think a lot of other people can say that as well. The fear here, though, is that Apple is getting too powerful in the space. They do make money off of fees through each transaction, though the amount is minuscule compared to what they make on things like iPhone sales. But these banks obviously don't like Apple jumping into their territory. Don't forget, Apple also has a credit card with Goldman Sachs, and they're working on a buy now, pay later program. So, obviously they see Apple as a threat and want to kind of cut that off. Whether or not people are going to be interested in doing that, though, that's really the big question. Apple Pay is so popular because it's so easy to use. You just double tap your power button or the side button on your phone, and it'll pull up your credit card and allow you to pay with either Face ID or Touch ID. So this is going to be up in the air for how successful this platform is.
Yeah, Apple's not going to make it easier for those big banks, is it? I haven't gotten cash in months, and heck, my kids don't even know what cash is. That must be one of the most underutilized, talked about stories going on in this economy. Stick with us, Dan. Another big story we're following here, tech layoffs. Spotify confirming in a statement it will lay off around 6% of its workforce. CEO Daniel Ek writing, quote, "Like many other leaders, I hope to sustain the strong tailwinds from the pandemic and believe that our broad global business and lower risk to the impact of a slowdown in ads would insulate us. In hindsight, I was too ambitious in investing ahead of our revenue growth."
Well, Spotify is one of the 174 tech companies with layoffs so far in 2023. That's according to trackerlayoffs.fyi. And a new survey revealing that there could be more pain to come. Nearly 20% of U.S. firms expect layoffs at their company in the coming months. That's according to a recent survey from the National Association for Business Economics. And Dave, I think the big question here, what so many people are asking, when you see a company after company in the tech sector announce layoffs over the last several weeks, whether or not that's indicative of what's going to come in the broader economy. And it's interesting once you start digging into some of the research that's been published on this. And Sam Rove, the ticker, did this over the weekend. He cited Goldman that was out with research back in November saying that the trends that they have looked at in the past when tech companies have laid off workers hasn't necessarily translated into widespread layoffs. And that's reflected when you take a look at some of the recent numbers that we've gotten in the labor market. Unemployment rate still extremely low. Labor market seems to be strong. So that might be a silver lining there, that maybe this is just some problems with companies that scaled way too quickly during the pandemic, and they're trying to correct some of that headcount now.
Right. Most of the companies we've seen do this layoffs, at least this year and late last year, scaled up headcount more than 50% based on pre-pandemic numbers. The only one that really hasn't, and that's why they haven't done layoffs, is Apple, who only increased headcount about 20%. And these are huge names, Spotify, big public companies that we're all familiar with, but very small companies. Remember, Spotify, only 9,800 worldwide employees, 5,400 here in the United States. So generally speaking, my answer would be no, it's not indicative of what's about to come in this space. I want to bring Dan Howley in on this. Curious your thoughts about this. Again, Tech makes up about 10% of our economy, but only about 2% of our workforce. So is it really a barometer of what's to come?
I don't necessarily think so. And, you have to look at what's going on with the tech layoffs in general. Yes, they're partially caused by the economy, kind of as far as the tech economy goes, pulling back from the explosive growth that we saw during the pandemic, right? A lot of these companies went out and, as you guys pointed out, hired huge numbers of employees thinking that there was a new normal, right? We would kind of all be online at all times. We would forever be on shopping on Amazon. No one's going to go to brick and mortar stores anymore. And we frankly just haven't seen that. People realized that they wanted to get back outside into the real world. And so you saw people start shopping again in person. Amazon is now suffering from that. That's why they're laying off those 18,000 employees. And we saw with the likes of Meta, Microsoft, Alphabet, there were these huge amounts of employees being brought on, but then they started to hit issues. Apple with ads, Alphabet with ads. The ad market obviously suffering as companies pull back on their ad spending. Ditto for Meta, but oh yeah, they're also spending billions of dollars on the metaverse. So they're dealing with two issues there. They still also, by the way, are just about overcoming the problems that Apple had thrown their way with their privacy changes. Microsoft, they overhired. We see slowdown in cloud and PC sales. So it's a number of different issues. This isn't necessarily a monolith when it comes to this kind of layoffs that we're seeing.
And it is maybe more indicative of what we're seeing in the podcast space here. We're seeing fewer mergers and fewer M&A activity, slowing ad growth like you just talked about, and really growth rates that are about half of what they were in 2020, although podcasts are still growing. It's surprising to see their head of content out. Really did a huge job there. Dan Howley, thanks so much. Coming up, are you not entertained? IMAX makes the most of the peak movie-going period in China with a big New Year's box office take. CEO Richard Gelfond breaks it down for us when we return. James Cameron's Avatar, The Way of the Water, has now crossed the $2 billion mark, and the world box office grosses $227 million of which has been on IMAX screens. Here now to discuss the business of blockbusters is IMAX CEO Richard Gelfond And Yahoo Finance's Ali Canal here with us as well. Richard, good to see you. Ali as well. How significant was yet another massive blockbuster hit from James Cameron?
Well, I think particularly at this time, very significant, because if you remember, coming out of the pandemic and China being closed, there were a lot of odds against movies coming back to pre-pandemic levels. And the studios made that worse with PVOD and streaming. Like, if there was ever a plague where everybody tried to kill us, they did. And I think reports of our death were premature. And obviously a film that's done this kind of business. And in IMAX, we did 12% of the world's box office on 0.5% of the screens. So I think it's kind of like a statement. It's like the Eagles this weekend or the Bengals. It's like
playing the audience here, Rich.
Come at me, come on.
Go Birds. I just got to throw that out there. But you mentioned China and Avatar doing well in China, those tickets outpacing there. But China, it's a difficult market, right? It's hard to do business there. You guys have a lot of visibility. What is it like having a business in China? What do you think the future holds for this? Because you have seen some successes lately as well.
Well, we've been in China for about 20 years, and we have 800 screens in China, which compares to 400 in North America. And I think by some measures, we've been the most successful kind of Western company in China. And recently, there's been a lot of good things that have been going on in China. So obviously, the COVID restrictions were lifted. People got sick, but they didn't die. And I think the movie industry is largely back. Also, 2 Marvel movies got in, Ant-Man and Black Panther, in the last couple weeks, and Shazam, a Warner Brothers movie, got in. So I think we're seeing that go back to normal. And this has become one of only 2 movies we've ever had in China over $50 million, Avengers Endgame and Avatar 2. So I think it's looking a lot better, certainly, than it did a couple months ago.
And when we think about the 2023 box office slate, do we have a film that will perform as well as Top Gun Maverick did in 2022? And if we don't, what does that say about the box office total for this year? And will we be able to reach those pre-pandemic levels again?
So I think you never know, right? Even when Top Gun came out, you didn't know where it was going to go. But there are a number of really anticipated films this year. There's Ant-Man, which comes out soon, and it's now part of the MCU. They've repivoted a little bit. And then you have Mission Impossible, now that Tom not only has transcended his former audience, has picked up a whole new audience. There's Fast 10, there's Oppenheimer. Guardians of the Galaxy was voted the most anticipated film this year. There's Aquaman. So especially for IMAX, we're in the blockbuster business, and the question is, how many blockbusters are there? So even if there's not one that does $1.5 billion, I think there's so many that we feel very good about the year.
It seems like if there's a part of movies that's gone for us, it's probably romantic comedies. In its place, is horror what can replace it, bringing people back to theaters? Certainly those big action blockbusters can. But what else can bring people out to the theaters?
So, I'm not sure that the movie industry is going to go back to where it was before, because there are a number of different challenges coming up, like obviously streaming is one of them, budgets to go out and market smaller movies. I think fortunately for us, the business of blockbusters is a really strong business. And, so I think 22, we haven't reported yet, but our outside China box office was pretty similar to what it was in 19. So for us, that's where we focus. But, I think there are challenges in the traditional movie business, and I think there'll probably be less screens, particularly in North America, and I think they're going to have to find different audiences. We have an IMAX Live offering. I think live content may replace some of what was lost before, and I think you're going to see people try different things, maybe gaming over time, sports may be it. But I think like many businesses, there are going to be changes, and hopefully for the better.
You said the magic word. I would love to see more sports in theaters. I know the college football playoff was aired at something like 75 screens. I think that's a huge opportunity. Amazon, we learned today, has a Easter release of Ben Affleck, Matt Damon's Nike biopic. In terms of their impact on the business, 12 to 15 theatrical releases a year, around $1 billion in spend. How significant is their entry for the movie industry?
I think there's no question it's a good thing. And so what you're referring to is Amazon saying they're going to premiere their movies theatrically. I think because of what you said, losing some of those mid-level movies, being able to bring in streaming content, like from Amazon. Netflix did Knives Out 2, and I think Apple's going to have some windows around some of its movies. And thank you for reminding me. I kind of missed that one as another thing that will make up for some of those movies diminishing. But I think it is a big deal.
And Richard, you sort of hinted at this, but you've repeatedly said that IMAX at its core is a technology company. It's not an exhibitor. As the industry has changed, what are you looking ahead towards when we think about technological advances and how that can add to value for both your partners as well as consumers?
Well, in the context of the core IMAX business, we're always innovating. You probably don't know this, but IMAX invented stadium seats and invented the modern era of 3D. In Top Gun Maverick, which you referred to before, we helped with the team that was shooting it invent special cameras that fit in the nose pit. So we're always like thinking of the next. We have a new sound system that came in. Our new technology is laser, which is bigger and sharper and looks really good. But outside the core business, we've done some other things too. So we recently bought a company called SimWave, which makes streaming content better in the home, and it also makes it cheaper to send because you can figure out how much to compress it so you could save the streamers money while contributing the same level of content. So we're always looking to follow the consumer, actually lead the consumer in many ways that we can. And that's our niche, and I think it's worked very well.
Fantastic. Richard Gelfond, great to have you here in studio. Appreciate you coming in.
Well, in this weather, you couldn't help yourself. So
in the rain, all dedicated,
rain.
Borderline snow.
For you guys, we're tough.
Ali Canal, thanks as well. All right, up next, powering up. Tesla was not the only EV maker whose shares got hammered last year, but two big competitors are having a strong session. Signs of a good thing ahead. We'll find out why. Next.
Time for a triple play. Three stocks that we're watching in the final 30 minutes of trading. We have Levi's, NEO, and Wayfair. Prosper Berminian here on set to help us break this down. Let's kick it off with Levi's. JP Morgan downgrading the stock today to neutral ahead of its earnings report on Wednesday. Despite that, though, shares still moving to the upside. Analyst Matthew Boss writing in a note that younger shoppers, they're opting for cargo, they're opting for twill, other pant styles over denim. Obviously a trend that would be a little bit concerning here to Levi, so that's sparking some of those demand concerns. He's the third analyst to cut his rating on Levi's this month, following earlier moves from Citi and from Bank of America. Pras, it's going to be a tough quarter, not just for Levi's, but really for the sector at large as consumers do begin to pull back some of their spending. Given high inflation and a deteriorating economy, Levi's could be poorly positioned here, at least in the short term.
Yeah, talking about some inventory that needs to be kind of gone through, thinned out a little bit, but twill and cargo, I mean, young people are buying those pants.
They are.
I mean,
and we have to follow them. They did make a point to say adults are still buying denim.
Okay.
I'm still buying denim. But, we normally tend to follow what the younger generations are doing. So maybe we'll be wearing twill and cargo
we
soon.
follow the young.
Sometimes
I've
we do,
bought
yes.
denim in almost 10 years.
You haven't?
Nope.
So what do you wear, twill
No
and cargo?
plans to. Come on, we know what I got stretchy yoga pants every day.
well, Dave,
Well, you're adding to some of the concern then. You're not even shopping at Levi's.
I mean, the 501, the iconic 501 coming out in a reissue, 150-year anniversary for those jeans, if you believe it or not. So those will be out there too. So, I might pick up a pair of that,
They're comfy jeans.
Please
just to
do.
be,
Next time you're here, we want to see you in 501s.
Levi's are cool.
Thank you.
They are.
Well, I'm going to restart the trend there with jeans anyway. Forget twill and cargo pants. So turning to this century, I'm watching Chinese auto stocks here, NIO, Li Auto, Xpeng. Big moves today. They're all trending on yahoofinance.com. Not much in terms of news, but we're seeing that continued optimism as China reopens. Automakers cutting prices there, renewed investor interest in growth names, and of course, Tesla earnings coming out in a couple of days. Maybe there's some enthusiasm there. Also in the world of EV, Citi resumed coverage of Lucid, the luxury EV maker, with a buy rating as well. So, we're seeing that kind of like pile back into those momentum EV car stocks.
Anecdotally, man, I am seeing more Rivians every day. Now, granted, this is in Connecticut, a very strange bubble of a market, but they're so recognizable from the front that when you see one. I'm curious, some reporting about how much the Tesla price cuts will impact others in, let's say GM, let's say Ford. Will they begin to cut their prices somewhere in that 10% vicinity, or do you think they'll hold firm?
The problem is that I think they have to, but the problem is that their margins are way thinner than Tesla is right now. So they'd be selling these cars at an even bigger loss. So they got to really be careful about that, distinguish themselves from Tesla if they want to keep up. But you're absolutely right. Those price cuts are huge for the market.
Yeah,
Game changer. A lot of pressure there. All right, my play is Wayfair, a trending ticker on Yahoo Finance. Shares soaring again today as JP Morgan's Christopher Horvers upgraded the stock to overweight and increased his price target by 80% to $63 from $35. Horvers' upgrade based on, quote, a positive shift in market share trends and management's newfound commitment to controlling expenses. Now, on Friday, the stock popped more than 20% after the company announced it was cutting about 10% of its workforce as part of a broader cost-cutting plan. If it holds, this would be the stock's biggest two-day rally since April 2020. As you can see, shares up 25+% on this day and up more than 80% year to date. Still, though, down more than 60% over the last year. But boy, they represent one of the biggest rallies we've seen this year. Just a rocket ship.
They have, and rally off of an extremely depressed level when you take into account the losses that you were just talking about over the last year, over the past 2 years. I think the big question going forward with Wayfair is the amount of cost cuts that still may be possibly on the table. This is a step in the right direction. The cost cuts that they announced, job cuts that they announced last week, was about 1,200 corporate jobs. So they're working to eliminate some of those management layers that they talked about, really restructure their business in order to be more agile in this environment. The street is getting more positive. JP Morgan isn't alone. Wells Fargo was positive on the cuts last week. Truist saying that it makes sense. But I think in this environment, they're still going to potentially struggle a little bit given the state of the consumer and what that could maybe look like in the next quarter.
You hear nothing about demand in those upgrades. It'd be nice to hear that.
Yeah, I think that is a key word. That would be nice to hear. All right, well, coming up, one size fits all. The FDA is considering a new streamlined strategy for COVID vaccines. But won't you miss counting your shots, your boosters, where you are going to go to get them, when they will happen? The full details for you next. The FDA announcing this morning that it is making a big change in its COVID-19 vaccine strategy. Yahoo Finance health reporter Anjali Kamlani is here with the latest. Hand.
Hey, Shauna, that's right. The FDA is planning to make changes with a meeting upcoming this week to talk about what the COVID vaccine strategy should be going forward. They're inviting their external advisors in to take part in this discussion and then cement the strategy. Here's what's on the table. We know that they're looking at making an annual vaccine, kind of like with flu, picking specific strains, whether we stick with sort of a bivalent focus, as has been the case now, to make it easier for production of these vaccines, as well as whether or not older individuals and the youngest of the population should get 2 shots annually instead of 1. So all of that is what needs to be discussed. This is not surprising. We have heard that this is sort of the direction that the government has been looking to go into. We also know the vaccine makers have been expecting it. Take a listen to what Moderna CEO recently said about that.
I think it's a bit like flu. You need to get the annual flu shot, not because the protein technology is not good. I believe it is really good, but because it's a different virus. And so you need to re-educate your immune system for this different virus, especially if you're at high risk.
So as you can see, he's already been preparing for that. The companies have already been preparing for that. But whether or not it is going to be a fall or any other time in the year, that's what we still have to wait and see. But we know what it's likely going to be for now.
Be interesting to see what the schools do. Will they require it down the stretch or will they not? Anj, also interesting that Abbott Labs, under a federal criminal organization. Can you break down what this is all about?
That's right. Department of Justice looking into specifically the Sturgis plant in Michigan that caused that shortage of baby formula last year. So if you recall the timeline of what happened, we know that there was initially an FDA inspection based on a complaint. There was a whistleblower report. The whistleblower was interviewed. Just a whole heap of events that led to the shortage that we experienced last year. And we know that that is something that has already been looked into at multiple levels. The Department of Justice now looking into it as well. So we'll see whether or not there was any, negligence or anything on the part of the company. They have said that they are cooperating with the DOJ, and we'll just have to wait to see the results.
Okay, Anjali Kamlani, thanks so much for that update. Coming up, we are counting down to the closing bell on Wall Street again. We're looking at gains across the board. Dow now up 244 points. We'll be right back.
All right, just a few minutes away from the closing bell now. Let's bring in Yahoo Finance's Jared Blickery to break down the market action. Hello, my friend. What are we seeing?
There. We're seeing some outperformance by the Nasdaq yet again, and this is what's happening this year. Nasdaq up 2%, more than doubling the Dow's performance of only 0.8%. S&P 500 up 1.25%. Russell 2000 somewhere in the middle. Now you're going to see tech. That's XLK in the upper left there. That is up over 2%, followed by communication services and discretionary. There we go. Discretionary categories up 1.6%. Now, this is interesting because guess what the best performing sector of the year is? It's XLC, that's communication services. Yet on a trailing 1-year basis, you'll see that this is the worst sector. It's down 25%, down considerably more last year. So let me just show you what's going on inside the sector here, also formerly the telecommunications sector. So I'm going to turn this back to a year-to-date board and just kind of show you what's going on. And I looking at this today because Spotify happens to be a member of this group. Of course, that's been in the news because of the job cuts, and you can see over the last year, this is a very depressed stock, though it is up considerably off those lows on a percentage basis. You can see down almost 50% year over year. Now, looking at some of the other big members here, Netflix is another one that's been in the news. That's up 21%, Alphabet up 13%, and so on. Just wanted to show you this because a lot of these sectors that have been the worst off last year have been the best off this year, and that's a theme that we've been going by. Now, I want to show you Bitcoin as well because if you've been paying attention to the news, hope you have, it is broken to the upside, and let me just put this on an intraday basis for our heat map. You can see it's up 2% over the last 24 hours. Over the last year, this is the biggest rally that we've had. In fact, it's the biggest rally since these all-time highs. It's nearly 50% that we've had since we hit those all-time highs. And it doesn't look like a lot right down here, especially compared because it's at the bottom of the chart. But nevertheless, that is up nearly 50% from the lows. Let me just show you what that looks on an intraday basis. Here is a 2-month look at Bitcoin. So we can see that liftoff right here. We'll have to see if this continues, but 20,000 is my line in the sand for Bitcoin. Now, we want to get to the retail sector as well. Let me see if I can find this. Here we go. E-commerce has really been picking up here, and Shopify is the stock that we want to concentrate on right now. Shopify having its best day since November, and this is after Deutsche Bank raises its recommendation on the e-commerce play to buy from hold with a price target of $50. Looks like we've got 30 seconds to the bell here. They're saying they expect enterprise adoption to accelerate this year, which should let the company to once again outpace overall U.S. e-commerce growth. And they're also saying Shopify is up 25% this year and 85% off of its fourth quarter low. So let me just show you a max chart on Shopify before we head to the bell there. Looking like a lot of those other pandemic charts, long way to go. And just broadening this out, I want to take a look at the movie sector just for kind of a look at what's been happening on the entertainment side. Here is your closing bell on Wall Street.
All right, well, that closes out today's market action. All three of the major averages closing to the upside. The Nasdaq, the outperformer of the group, with the Nasdaq closing up just about 2%. We're looking at the S&P up just over 1% and the Dow closing up 253 points. It was up just over 400 points at the highs of the session. All right, let's take a look at some of the movers, top movers of the day. First up, we got to talk about Microsoft shares closing to the upside after the company officially announcing its extended partnership with OpenAI. That's the parent company of ChatGPT. The gains that we're looking at today is just about 1%. Taking a look at what this could mean for the company down the road here, Dave, this deal we know adding to Microsoft's initial investment of about $1 billion back in 2019. Analysts are very bullish about this. Dan Ives from Wedbush, we've talked to him about this potential investment when it was just reported, but he's sending out a note today calling it a potential game changer for Microsoft, saying that it is a direct shot to Google and other big tech companies, saying that Nadella & Co., Satya Nadella, is ahead of the rest of big tech, and this investment is a major notch on the AI belt. Doesn't get much more bullish than that.
No, it doesn't. And let's talk about those two things. One, what the threat is to competitors. Well, we know from some New York Times reporting that Sergey Brin and Larry Page have come back to the founders of Google have come back, and they're not back at all because of the threat of ChatGPT. They know how big this is. And the theory is that it's actually a threat to Google's search business, which many have balked at, because how significant could Bing be? Well, apparently it's big if you've got the two founders of Google coming back. But what does Satya Nadella say today? We believe large-scale AI, like chat, will create transformative impact at the magnitude of the personal computer, the internet, mobile devices, and the cloud. That's a pretty significant statement about what he believes ChatGPT will do, completely disrupt just about every industry out there.
Yeah, exactly. And it's coming at a time that this investment here, at a time when Office, Azure projected to slow meaningfully. That was the crux of Barclays' note out on this today, saying that it could not have come at a more opportune time. We'll get results from Microsoft tomorrow after the bell, where I'm sure a question or two are going to be on OpenAI.
That call will be interesting. We certainly won't see ChatGPT in the earnings themselves, but some commentary will be fascinating. We also have coming up on this program a young man who's a Princeton student that has already invented an app that would detect cheating by ChatGPT. You can tell if it's written by a human or AI. That's coming up. Also, Salesforce has been in focus all day amid activist investor activity. Elliott Investment Management announced that it's taken a stake in the company, and CNBC reporting Inclusive Capital has also taken a position. We spoke to Patrick Gadsden, who has dealt with this company in numerous times, Elliott Management. He knows all about Paul Singer and what they are in this industry. Here's what he said.
They are the Godzilla of the space. Right? They make entire countries in South America tremble. So they are known to see things all the way through. And, many activists are sort of price sensitive when it comes to running campaigns. Elliott is not. They are completely inelastic when it comes to their budget for any proxy contest, any proxy wars. They'll spend tens of millions.
If you weren't familiar with Paul Singer and Elliott Management, well, now you are. Look at Salesforce, up 3%. I guess because what we just heard there from Mr. Gadsden is they don't lose. They have no time frame, and they don't care what they have to spend to win. They're going to get the job done, including with entire countries like Argentina.
Yeah, exactly. He said when they walk in the room, you sit up straight and you pay attention. That's simply what you have to do when you're dealing with Elliott Management. When you take a look at Salesforce, clearly the stock has been under pressure, as well as many of its competitors out there over the last several months. A one-year chart, you're looking at losses of nearly 30%. Some key executive changes have happened over the last couple of months. The co-CEO, Bret Taylor, leaving the company. A lot of people asking Benioff some questions just in terms of what this means for the direction of Salesforce going forward. In terms of what the street is saying to this, Needham saying that the guess is that the outcome is all about margin expansion. Question whether more layoffs could potentially be on the table. We know Salesforce was one of the tech companies to announce a significant amount of layoffs earlier this year. So I think the company is under pressure. More and more activist investors paying more attention, taking stakes, reportedly, at least when it comes to the smaller company. Elliott Management, though, confirming that stake today. We had Starboard back in October, so it's getting more attention from activist investors. We'll see what changes are actually made.
Yeah, and we don't know what they want, but it was an interesting revelation from Gadsden. At least his interpretation is that why do we learn about reports like this? Why are we hearing it? And his theory is it's because something already happened, probably a late Q4 development. In his estimate, that could be a complete breakdown in those talks, or they're about to announce something, i.e. board appointments. So his theory is something has happened, either positive or negative, to break that story.
Yeah, and just take a look at the track record here when it comes to Elliott Management. They've dealt with PayPal, AT&T, Dell, Pinterest, just to name a few in the past, and forcing numerous changes at those companies. So Benioff under a bit of pressure today, likely for a couple of weeks. All right, let's talk about the chip stocks here. They are among the leaders in the Nasdaq today. Barclays out with a bullish note, upgrading AMD, Qualcomm, and reiterating a buy rating on NVIDIA. They don't see the group of stocks retesting those October lows. A bullish call here from Barclays. The Philadelphia Semiconductor Index, that's up more than 30% from a 2-year low in mid-October. Analyst Blaine Curtis here of Barclays saying that he's more positive on companies with the data center, PC, handset exposures. Also, the reopening in China will start benefiting the industry he sees in the second half of the year. And you're looking at a 1-year chart of the Philly Semiconductor Index, despite that 30% rally off the lows, still off about 14% this year, with a number of those larger chip stocks in the red over the last 12 months as well.
And you know where I'm going to go with this, ChatGPT, because there was a number of analysts who said there's one name that's probably going to benefit the most from this, and that is NVIDIA. They are poised to benefit the most from the bounce from ChatGPT, including Citi, which said that is why they believe in NVIDIA moving forward. As for that Barclays note, they added, this is a frown turned upside down. We still see this correlation as the worst since the tech bubble, but we are modeling estimates below for nearly every name in our coverage, even without a macro downturn. Very good day for chip stocks. Look at that, up almost 8%. For NVIDIA. All right, let's turn now to Tesla. CEO Elon Musk testifying in federal court this afternoon, insisting that the tweet at the center of this case, in which he claimed he would take the EV maker public at a $420 stock price, was not a joke back in 2018. Of course, Yahoo Finance's Alexis Keenan here with the latest. What did we hear from Mr. Musk today on the stand?
We're hearing a lot, and he's first taken questions from the shareholders' lawyer in this case, and he's just now turned, before I came on the set here, to talk with his own lawyer, who's now under questioning with him. But he said this $420 price, he was asked, was that a joke? Was that to impress your girlfriend? Musk said, no, certainly not. It was a coincidence. It was rounded up from $419 a share.
He said it was a coincidence.
He said it was a coincidence.
$420.
That's down in his testimony. Signed, sealed, and delivered. But I want to take you through some of the other key testimony that's coming from Musk, while you keep in mind that what the shareholders have to prove here is that that funding secured tweet was cause for the stock price to artificially inflate and then come back down. So I think we have a screen too of the stock price as it traveled through that tumultuous time in August 7th through August 17th of 2028. Now, Musk has said that the driving factor that made him tweet this tweet was the report in the Financial Times that came out that same morning on August 7th with advance notice that Musk had received that this report was going to reveal that Saudi Arabia's public wealth fund had acquired a 5% stake. Now, that was not public information at the time, so he said he had concern that another leak would be coming because they had this good detailed information. Musk knew that he was already in talks with the fund, he says, to get this funding and get this deal to take Tesla private. So he said he wanted to get out ahead of that and not withhold information from shareholders. He said he knew the rules from the SEC, that he had to equally distribute information to shareholders, so he tweeted this information to get ahead of that news. Now, he also said that this material information, of course, would not normally be made public during the trading day, but he needed to get out in front of it anyway. He said that the fund's media denial, right? So Saudi Arabia later came out, the fund, and said, no, that's not true. There was no funding secured. We weren't at that stage of the negotiations. Musk called that ass covering, public ass covering is what he said. He said he did try to subpoena the fund for testimony, but of course the fund and its people are out of the jurisdiction of the United States, so they were unsuccessful in doing that. But he did admit a couple of key points here. Musk said that he hadn't signed, that the fund, the officials hadn't signed any documents related to this funding, this deal. So there's nothing on paper. He said it was an oral commitment. This was something that happened in meetings, in talks. And he said he had a handshake deal for this commitment. He also admitted that he had sought no specific legal and financial advice for this deal, but he said that he was relying on financial and legal advice that he got in his SpaceX deal. And so that history there, he said he had some ideas about how this very unusual transaction would come together. He said that SpaceX structure could perhaps have been a structure that he could use for this proposed deal.
I'm not buying the 420 part, but some solid explanations in there latter as per what he wanted to reveal.
He's been working on it for a while. He's been working on the defense.
Yeah, he came around to it. Alexis Keenan, great stuff. Thank you. All right, coming up, what inflation? Consumers were out in force this holiday season, spending big bucks on dining out and wearing out the latest trends. But Are we about to pay for all that? We look at some retail wild cards when we come back.
Nordstrom, the latest retailer, slashing its annual profit forecast on weak holiday sales as consumers cut back on discretionary spending. And they're not alone. Macy's warning its holiday quarter will come in light, while Lululemon said that it expects profit margins to drop. Here to discuss that and more, we want to bring in Steve Lamar, American Apparel and Footwear Association CEO and President. Steve, it's great to see you again. So some of the weakness, some of the concern that we've been hearing from CEOs, from executives in the retail sector, what do you make of it, and what do you think that signals for the year ahead?
Well, I still think that, consumers were out in force, this past holiday season. They were looking for good deals, looking for a way to stretch their dollars. And, what I saw in the numbers was what I would call a measured but strong consumer, which is really important in our consumer-driven economy if, we want to engineer that soft landing we keep talking about and really build in sustained long-term growth.
What are you broadly seeing from the consumer right now? It's an interesting mix to see retail sales in December down 1.1%, but the National Retail Federation showed a pretty big pop for the holiday season. What are you seeing?
Well, consumers are still out. They still need to buy. And, we hear this discussion about, moving from goods to services and experiences. And yeah, one of the things that we often realize is that even in experiences, you need to have, the right fashion, whether it's product to go out outside, product to go to, a dinner, an event, whatever it might be. So there's still room for a lot of fashion and a lot of clothing and shoe purchases, even when consumers are switching to those more experiential items.
And Steve, two big issues that we have seen consistent throughout the sector here, inventory levels and also supply chain issues. How real are those challenges today? And do you see that significantly improving soon?
Well, I think both of them have improved. I mean, there's always going to be supply chain concerns. You're looking at, we're coming out of or going into Lunar New Year right now. So the question is, when you come out of Lunar New Year, how long will that take for that to resolve? And of course, we're coming up on the 6 month of the West Coast port negotiations. We still don't have a long-term deal there. So those are always raising concerns. At the same time, people have been working for, supply chain normalcy for a very long time. And I think during the last 3 years, people have been really flexing those supply chain muscles to build in agile, flexible supply chains, really to be able to respond to just about any situation. I'll tell you, the big thing that's really tripping a lot of people up is, the Biden administration is still charging very, very high tariffs. These Section 301 tariffs. So I've actually now collected more tariffs than the Trump administration has. And those tariffs, they're not changing behavior in Beijing. They're just making it more expensive for people to get to work and just raising costs at a time when people are trying to address inflationary issues.
How do you quantify the impact of those tariffs?
Well, it shows up as prices. I mean, look at a case of, we're looking about pocketbook issues, right? We talk about this all the time, and it's kind of hard to be sensitive to pocketbook issues when a pocketbook itself is going up 40% because the tariff rates can add that much to the price of the item itself.
Steve, Biden hasn't reversed the Trump era tariffs. What have your conversations been like with the administration? And are you optimistic that maybe we will see some of those tariffs peeled back?
Well, we're right now in the middle of a review. It's this 4-year review where the administration is trying to determine whether it's a good idea to continue them, to continue these tariffs. And in all of our conversations, we've been pointing out that, tariffs are fundamentally, especially tariffs on clothing and shoes, fundamentally a regressive tax. I mean, it hits those lowest income Americans hardest because these are basic needs. These are items that they can't afford to do without. So we think the administration is very sensitive to that. I think they still want to look tough against China, and they still want to look like they're using trade policy to advance some of those fairness issues. We agree. We just don't think tariffs are the right way to do it.
How would you characterize the China reopening? How does that impact your industry?
Well, it'll be good news. I mean, look, we've been very saddened to see the COVID spikes and outbreaks that have been going on. But over the next couple of weeks, especially as you go through the Lunar New Year, you're going to start to see more and more, I think, supply chain normalization occur from China itself. And as we've been looking at these supply chain challenges over the last couple of years, a lot of times it's because of disruptions that have been going on in China as a result of the zero COVID strategy, not because of outbreaks. So as we start to see that normalization occur in China, I think that's going to greatly benefit and positively affect the rest of the world.
And Steve, you represent your company here represents more than 1,000 brands, 1,000 retailers, your association there. What are the conversations that you're having with the CEOs, with executives today, and how have they changed from what we've been talking about for the last 12 months?
Well, I think the big focus right now is really trying to maintain that agility with supply chains. I mean, over the last couple of years, people have learned some very important lessons about making sure that your supply chains are better suited to manage all kinds of challenges and even challenges that you don't foresee. And so, what can you do to make sure that your supply chains are really well situated for that? And I think that's what a lot of people are really looking at right now.
American Apparel, Footwear, and Apparel CEO and President Steve Lamar. Good to see you, sir. Thanks so much. All right, watch this space. Activist investor campaigns are ramping up this year after a busy 2022 where rocky markets offered opportunities for some of the world's top investors to shake things up. Now, Bill Ackman, for some, the poster boy of this space, has taken a stake in the British watchmaker that he wants to make a global leader. Yahoo Finance's Praz Subramanian, a watch connoisseur, I do believe, has more.
Yeah, Bill Ackman putting his money where his mouth is. He's hungry to put that money to work, I think. But, it's not actually an activist stake here. He's actually a fan of the brand. The story goes, he bought a Bremont watch in London, loved it so much, wrote a letter to the co-founder saying that he wanted to get involved and wants to learn more about the company. Lo and behold, they're actually raising money to grow. Bill Ackman, billionaire, has money to do that, help them grow. So he said he's putting money, $59 million, along with another fund to fund their growth. So very excited here. And he says he's a long-term player, not a typical PE investor. Says he, quote, wants to be a forever investor. Sounds more like Warren Buffett, if you kind of ask me, you know?
Hey, Prez, what do you mean just of the interest that we have in the watch space right now? Obviously, Ackman getting into this, clearly a very high-profile, well-known name in terms of some of the changes that he might bring to this brand. What do you see potentially happening? You know, beyond the money, right? He's also a very known quantity, can raise more money, is a pretty, obviously a well-connected guy. But I think the watch space itself has kind of blown up since the pandemic, and maybe he sees an opportunity here for big growth. He notes that Breitling, Swiss brand Breitling, sold to a private equity company for $4.2 billion. So, you know, right now, Bremont's kind of a fraction of that. So maybe he sees that long term, this is actually potentially not only a play for him for his interest, but also a play that can make him some money down the line.
Are they in that price category, Bremont and Breitling? Same neck of the woods?
Ish. So Bremont watch start around $3,500 up to $25,000 or so. I think Breitling's a little bit more in the $5,000 to $6,000 starting range, then it goes up exponentially from there. So we're in the same aviation theme kind of watches. That's the whole kind of vibe with Breitling and also Bremont too. So I guess what we're seeing is that kind of, can they emulate that playbook from the British watchmaking side, which is kind of like a new thing.
All right, Pras, thank you so much. Appreciate that. Coming up, Northeast cities like New York and Philadelphia are not seeing snow this winter, and it's having a noticeable impact on the energy sector. Find out how next.
Welcome back to Yahoo Finance Live. The price of oil creeping higher after falling below $73 a barrel earlier this month. Crude oil is gradually clawing back some of those gains. Both WTI and Brent now at early December highs, with crude closing the day just below $82 a barrel. We want to bring in Stephen Schork, the Schork Group principal. Stephen, it's great to see you again. Certainly the trend has been to the upside when it comes to crude prices. Where are we headed? Are we headed even higher from here?
Yes, that's where the current trend is taking us now, Shauna. The narratives are winning out. The narrative being that market now is focused on China reopening. Market got a nice boost a few weeks ago when China increased by 1/5 its slated crude oil imports for the new year. You have growing optimism out of OPEC that demand is going to stay strong. So that narrative is winning over the other narrative, that is demand destruction vis-a-vis economic contraction here in the U.S. with certain macroeconomic signs pointing towards recession. Be that as it may, the China narrative is winning out. To your point, we did stumble out of the gate coming into 2023. We took a significant leg lower in the first week. And that was kind of payback for the significant leg higher we took going into the end of 2022. But we got down into the low 70s. And here's the problem, because the White House now has painted itself into a corner. They came out, they've depleted the SPR, and yet heating oil prices this winter are 58% higher. Gasoline prices for next summer are 30% higher. We've depleted the SPR. And then the White House came out and said, when oil prices get back into the low 70s, we'll start buying it. So here at the Short Group, we're calling that the Biden put. Why would anyone want to sell oil in the low 70s or below when Uncle Sam is going to step in with the bid on a couple 100 million barrels? So we're looking at a de facto floor in the market at this point. So now you juxtapose that with the positive narrative of China reopening, and you do have the seeds for higher growth and price from here.
Energy Secretary Jennifer Granholm saying today that Biden has been focused on reducing energy costs. How high do you think we are headed? Are we going back above $100 a barrel? And what about the price of gas, up 10 cents in a week, up 30 cents in a month? How high there as well?
Right, and we're going into that now part of the season where we're looking at low inventories. So unless the Secretary of Energy could take some of her magic pixie dust and float it over the market and increase supplies when the supplies are at extremely low levels, this can't happen. So the only arsenal in this White House's quiver now has been to what? Go into the SPR. And I've just said the SPR, it's been a non-starter. We're just depleting our emergency supplies of oil. We've depleted our forward cover by nearly 40%, and prices, again, are still significantly higher. So the Biden administration has no tool that it can use to lower price. What it could do is embrace consumption, stop demagoguing and scapegoating the industry, and encourage investment and encourage these producers to come back in full force. But they've been reticent to do that. They've taken a very hawkish stance against their own domestic producers. So this administration does not have any options at this point. Hence why we're going to Saudi Arabia, we're going to Venezuela, we're asking them to increase production. The Biden administration, President Biden has not stepped foot in the city of Houston to talk to producers, but we are talking to Saudi Arabia and Venezuela. So we do not have a domestic energy policy, regardless of what the Secretary of Energy wants to say. We do not have, and hence why we're looking at higher prices. So, right, we are now in the weakest part of the season when it comes to demand. And that is going to remain so for the next couple of weeks. So if we hold at these levels, mid 70s to mid 80s, going into the late spring, summer, when demand picks up, yes, we'll be looking at national gasoline prices well back above $4 a gallon, oil prices well back above $100 a barrel. That is in the cards.
Stephen, we've also got energy earnings coming up over the next couple of weeks. We have Chevron on Friday, Exxon a week from tomorrow. What are you expecting to hear from the oil giants about the past quarter? And have we seen a peak, at least for this cycle?
The crack spreads have been great. That is to say, the differential between the product price, what the refinery is selling, and the crude oil price, what the refinery is buying. So that margin, that spread called the crack spread, has been very attractive. And I would suspect that it certainly will help continue to propel profits higher for the most part. So if we're going into the season, and certainly we're at that weakest part of the season, but the market from the margins, the spreads have only been increasing. And again, this here is a clear telltale of a lack of supply in this market. That is to say, the forward curve, prices on the forward curve are much higher than prices later dated out further out along the curve. This is a clear telltale that demand is outstripping supply, and the spreads are telling this. And if demand is outstripping supply, and if you are producing that supply, selling in that demand market, it's a very attractive area to be in right now.
We'll be paying very close attention to those earnings reports. Stephen Schork, thanks so much. Well, coming up, concessions are becoming more frequent in the housing market. Find out what new opportunities are popping up for home buyers when we come back.
Home builders are feeling a bit better about the housing market, albeit just a bit, as sentiment ticked up in December for the first time in a year. Let's talk about where housing is headed and where it's hot in 23 with Kinlock Partners co-founder and CEO Bruce McNeilage. Bruce, good to see you back here. Broadly speaking, how do you characterize what you're seeing out there in the market to start this year? And is the worst behind us?
So I don't think it is. I think we are going back and forth. I think the market is still finding itself. And I think builders have really adjusted to things, to increase sales, to increase traffic in their models. But I don't think the worst. I think we've got some ways to go before we start ticking back up in the housing business.
We are seeing home builder stocks up pretty much across the board. KB Homes, Toll Brothers, Lennar, D.R. Horton, all of them up between 5 and 11%. Now, granted, that's after a tough 2022, but are you optimistic for the home builders, and what are you hearing from them?
So I've taken a poll and talked to many of them here in the last few days, and they're seeing more traffic, but traffic doesn't necessarily equate to sales. And so people are coming in, they're looking at the houses. The builders are doing a great job with concessions and some incentives buying down the mortgage rates, the interest rates. And so we're starting to see some things turn, but high interest rates, the 6.5% or so range for the 30-year fixed mortgage that rate is still keeping some people away from buying houses.
Where do you see that mortgage rate heading in 2023, and where do you see it flattening out? Will that be enough to kind of thaw things out?
I think if we can get to 6% sometime to the middle of the end of this year, that'll really help builders and also buyers of homes. The people that are most affected are the entry-level buyer. And I think with the incentives, maybe reduction of prices a little bit, and the easing of these mortgage companies to give mortgages, I think will really, really help.
You talked about concessions. It's remarkable how many of them. That has really been the theme of 2022, which continues into 23. 42% of all transactions in Q4 had concessions. That's almost double from earlier in the year. What types of concessions are you seeing the most and where?
The two most popular concessions are not only the reduction in price, but giving large builders credits or buyers credits. It might be refrigerators, it might be blinds, it could be closing costs, title insurance, but they're also offering incentives that I really think is the best incentive. If rates were 6.5%, 7.5%, these builders are buying down the rates to 4.9%, 4%. And that really helps buyers because buyers are buying a payment. That's what they're looking for. What will their monthly payment be? And so if builders can buy down that interest rate, that's really what's going to drive people to the models. And then some inventory that hasn't sold, some standing inventory, I think people have a good opportunity to pick up some good deals if they're looking to buy a home.
Good stuff. All right, the National Association of Realtors put out the top 10 housing markets for 23, all of them, all 10 in the South, the majority in the Southeast, with Atlanta taking the top spot, Raleigh, North Carolina, number 2. Why are those markets so hot? And is that where the majority of investment is also happening?
So my firm exclusively invests in the Deep South, both in Tennessee, Georgia, and throughout the Carolinas. We are seeing that's where migration is going from the Northeast and the Midwest. We're all seeing manufacturing jobs. There's an awful lot of automobile companies and manufacturing jobs going to the Southeast. And quite frankly, it's the cost. When you can buy a house for $275,000, $300,000, $325,000, a 4 or 5 bedroom house, that's also really going to be something that drives people to that city. And the jobs are also there. So those two things are really making it a very positive for the Southeast.
Yeah, Redfin says today a record 25% of users look to move in Q4. That is a record, and apparently they are moving to the South. Finally, Moody's has new numbers out today showing a record high 30% share of spending going towards rent in this country. Will you see that improve, do you think, in 2023? That is a massive number.
It's a big number. And here in Nashville, I've seen it as high as 40 and 45%.
Wow.
Of course, in San Francisco, Los Angeles, that number's higher. But no, that number's not coming down. Now, rents this year will not have the robust increase that they've had last year of over 10%. I think we're going to see that relatively flat. And also, home rental companies like ours are starting to give incentives that make it more affordable for people to get in a house, but the high payments are still there.
Are you offering rental incentives?
We are in a couple cities in the Southeast. We are offering 1 month rent with a 1-year lease, or we're offering a 2-year lease where you're not going to get an increase in the second year. We've had a very good response from that program, and we see more and more companies doing that. And I think that's really helping ease things with the consumer that might not be able to buy right now, but is still looking for a high quality house for them to rent and their families to enjoy.
And is the inventory story changing for the positive in the rental space this year?
So inventory is still tight. However, people were building into that cycle in the downturn. So there seems to be a little bit more in the market. That's why we have a flattening out of what's going on as far as rental prices. And I don't really see that changing. There's been a lot of spec houses, inventory has gone up for some of these builders. And because individuals haven't been able to qualify or have been a little gun shy to buy a house, builders are selling their houses at discounts to rental operators like us throughout the country.
That trend continues. Bruce McNeilage, excellent observations. Good to see you. Thanks again. Coming up, there are growing fears about students using ChatGPT to cheat on their assignments, but one entrepreneur has built an app to help teachers suss out who may be using it. He joins us next. OpenAI's ChatGPT is smart enough to pass a final MBA exam at the Wharton School. That's according to one of the university's professors. So how does higher education know it's a student or a computer program submitting their next paper? Enter GPT-0. The new program created by a 22-year-old Princeton student allows users to copy and paste text and test whether it was computer generated. GPT-0 tests the texts and provides a perplexity score followed by a GPT-0 score. That 0 score determines whether the text is human generated. In the result you're watching now, the New Yorker article shown was in fact written by a human. Joining us now is the creator of GPT-0, Edward Tian. Edward, great to see you. Bravo. How do you know this is absolutely foolproof? And do you get a sense of how prevalent cheating is with ChatGPT?
First, thank you so much for having me. It's a pleasure to be here. I would say, yeah, GPT-0 was something I built over my holiday break, just at my local coffee shop in Toronto. And I was completely blown away at how it just literally went viral. It is not foolproof. We put a disclaimer not to have any make definitive academic decisions off the beta, but what we have done is put up a product wait list for educators that are interested in using it professionally. And so far, over 23,000 educators from more than 40 states and 30 countries have signed up for that. So we're really excited.
Edward, you make it sound so easy. I think if I was tasked with this, I don't know if I could do this over an entire lifetime, but what was your motivation for this? Because I know you're writing your thesis about AI and you have a lot of interest just about AI and the role it will potentially play in the future.
Yeah, for sure. Aside from the research and academic interest, I think the concern was the immediate need in terms of education to sort of adopt this technology responsibly. Because I'm not against, students using ChatGPT. Instead, I'm actually for students should, and our generation should be exposed to these new technologies, but it has to be done responsibly and fairly, but as well as bigger concerns in terms of bots. I've looked at in the past with like over an internship with the BBC, like bots, Twitter disinformation, as well as fake news being generated by these techs. That's all of concern. And we need to have tools and safeguards so these technologies are used and not abused.
What are you hearing from teachers? What are you hearing from students that gives you a sense of, again, how prevalent cheating is with this technology?
I would say in terms of from teachers, the reception has been phenomenal. In fact, I was just back at my high school this Friday and talking to all my teachers, and my own high school English teacher was telling me that, yeah, students, like, they have no doubt that their students are all using this. But what's exciting is some teachers are thinking about also integrating ChatGPT in their curriculum in terms of maybe asking it to help generate writing topics or prompts. So the jury's still up in how educators are adopting these technologies, because these technologies are here. We can't ignore that. We have to build the tools to adopt it responsibly.
And we're talking about exactly how this works when it comes to detecting cheating, or if a human in fact wrote this. What are the certain things that you're looking for in order to alert that teacher, that professor, that this has actually been plagiarized?
Yeah, one of the indicators that GPT-0 is looking for is burstiness. Burstiness, in a sense, is variance in writing in terms of, you can think of it that humans have creativity. And because our short-term memory, we have sudden bursts in creativity and differences in our writing, while machines have pretty ubiquitous and constant writing over time, especially if these machines are as powerful as ChatGPT.
The New York Public Schools recently banned use of ChatGPT. Do you think districts around the country should follow suit?
No, I actually don't believe that's the right approach at all. First of all, if I was a high school student, I'd just be using ChatGPT on my own public Wi-Fi or Wi-Fi at home instead of at schools. Secondly, these technologies are here, and I absolutely believe AI is here to stay. It is the future, and students shouldn't be taken away the opportunity to interact. It should be adopted responsibly, as well as soon, ChatGPT will cost money. So it's no longer just a responsible AI issue, but also an equity issue, because students in low-income neighborhoods might just never have access to this technology, when students in higher income neighborhoods might be paying for it. But if there's a blanket ban, then we actually don't know where it's being used as well.
Yeah, certainly many factors to consider here. Edward, when it comes to GPT-0, I know it's only been several weeks here, but I'm sure you've gotten a tremendous amount of interest from VCs, maybe some larger firms that are showing interest in you and also your product. Have you gotten that interest, and what have those conversations been like?
Yeah, it's actually super exciting. Those from media, being a journalism student, this is like really exciting for me to talk to people, as well as being able to talk to VCs. I would say at the moment, we're focused on the engineering and actually building this tool out. And soon, we're happy to think more on the business side. In terms of individual educators, how this looks like is that I'm pretty committed to keeping GPT-0, or at least the copy and paste and hit enter online version, free forever. We do want to have a tool that everybody can access, because it is an important tool to have. And I think everyone deserves a tool like GPT-0 to use as well.
Edward, what do you think the best practical application for this technology is? We've heard theories all over the map, but you've studied it. Where do you think we'll see it develop the best in our economy, in our society in the next couple of years?
Yeah, I think like AI generation is going to be everywhere. In fact, I actually use it in my own coding. I use Copilot, which is GPT for code generation, just like ChatGPT is GPT for chat generation. So it's really going to be ubiquitous. I know Microsoft is already looking at implementing OpenAI models into their products as well. So it's really going to be more and more accessible.
Edward, in terms of the advantage that Microsoft now potentially has because of the investment with OpenAI and ChatGPT, is there anything out there from your experience, from the research that you've done, that's even close to where ChatGPT is today?
Yeah, I would say in terms of like research as well, there's many other models that are doing this work, not just like OpenAI models, but there's models in different countries. I know Tsinghua University has lots of research in natural language models, as well as BERT-based models. So as opposed to these GPT-based models, but I really don't think anything has broken the barrier in terms of accessibility like ChatGPT has. No other group really comes close in terms of how popular ChatGPT has been used.
Just a quick question. Any of your Princeton classmates furious at you for developing this product?
I wouldn't say so. I think it's been pretty awesome. My classmates have all been pretty supportive. Professors as well have been pretty supportive, including my own thesis advisor. They're all pretty happy and proud.
All right, I got a 15-year-old at home who's not so happy with you. Edward Tian, congratulations. Good stuff. Great to have you.
Thank you so much. Thank you so much for having me.
All right, my stock to watch for tomorrow is Johnson & Johnson. The healthcare giant reports its fourth quarter results before the bell Tuesday. Analysts are expecting J&J to report earnings of $2.23 per share on $23.9 billion of revenue. We'll be looking to any updates on production of its COVID vaccine, as well as news on the effort to spin off its consumer health division, which will be known as Kenvue. All right, coming up right here, one of Amazon's newest films will be coming to a theater near you. Some big stars and a massive company you're very familiar with. We'll talk about it next.
Amazon announcing it will release its film Air in theaters. Air is about the creation of one of the most successful brands of all time, Air Jordan. Now the film is being produced by and will star Ben Affleck and Matt Damon. Other stars include Marlon Wayans, Chris Tucker, Viola Davis, Jason Bateman, just to name a few there. A few months ago, Bloomberg reported that Amazon was planning to release 12 to 15 films in theaters and would spend $1 billion to do so. Dave, I think this is such a smart move by Amazon. They picked the perfect film to do this with. And you talk about people wanting to go back to the theaters, getting that extra exposure. I think it's a huge home run potentially here for Amazon.
Oh, Affleck and Damon, how about them apples?
2 stars.
I mean, that takes us back to Good Will Hunting, one of the all-time great films. And tie in Jason Bateman, one of the most underrated actors on the planet.
Love him.
Quite frankly. And yes, this is the kind of movie coming out of the pandemic that we just don't see very often. We know the avatars of the world can succeed, but films that you can go to with your whole family, your kids and the parents want to see together, bravo. Looks like a terrific cast, and obviously the story of Nike is one related to Michael Jordan that we all relate to and we all want to hear about. But big picture, you can't help but wonder if this is what Amazon is going to do, going to have a very positive impact on the movie theater and the film industry as a whole. We talked to Richard Gelfond, the IMAX CEO, about that. He was very excited about the prospect for the films that they're going to get in theaters. Right when we see the pipeline of films looking like it's flatlining, Amazon could be that shocker that the industry needs. 12 to 15 films a year. Very excited for it.
Yeah, I think it could be huge. And we know we've seen some resistance from Netflix, some of the other streamers, just in terms of releasing their movies, their new content in the theater, some of that resistance of the traditional model. So the fact that Amazon is taking this leap and releasing so many movies, up to 15 this year, that is a huge win, I think, for the industry. And like you're saying, they're doing anything to get people back into those theaters, so something to be optimistic about.
Yeah, we're all wondering what they would do with this when they acquired MGM for what it was, $8.45 billion. Now we're getting a glimpse. We'll see that on Easter weekend. That might even get you back to the theaters.
I was going to say, that might get me back to the theaters.
It'll get me there. All right, that'll do it for us today on Yahoo Finance Live. Be sure to come back tomorrow at 3 p.m. Eastern for all your coverage leading up to and after the closing bell. We'll see you tomorrow.